Today on Inspired Money.
So it turns out knowing when you're in a bubble is not crazy difficult because you can see the distortions in the marketplace. Knowing where it's going to crack is quite hard. Is it going to be high yield sovereign bonds? Is it going to be private equity debt? Is it going to be, where's it going to crack? It's hard to tell.
This is episode 143 with Associate Professor at NJIT Martin Tuckman School of Management, Michael Ehrlich. Welcome to Inspired Money. My name is Andy Wong, a managing partner at Runnymede Capital Management. Each week, we bring you an interesting person to help you get inspired, shift your perspectives on money, and achieve incredible things. From making it to giving it away, Inspired Money means making a difference, creating something bigger than oneself, and maybe, just maybe, making the world a better place. Thank you for joining me. Hey, Inspired Moneymaker, welcome back. If this is your first time with us, welcome. Today we're talking to Mike Ehrlich, who has a PhD in economics from Princeton University. He's an academic, and he also has extensive experience on Wall Street and has been a lifelong entrepreneur. He definitely brings a unique mix of real-world business experience along with academic theory. During this unusual time of drastic economic slowdown and the stock market rebounding sharply, perhaps most importantly, the focus of Mike's research is on financial market failures and financial bubbles. In this episode, you'll learn what Mike thinks about the financial markets during the COVID-19 pandemic, why you should be wary of bonds that have higher credit risk, bubbles, the Federal Reserve Bank, and risk in the financial markets. Now let's get inspired with Mike Ehrlich. Mike, welcome to Inspired Money. It's so great to have you on the show.
Thanks. It's really great to be here.
Let's jump right in. What's your earliest childhood memory of money?
I was about 5 years old, and our neighbors, there was this great big field across the street from our house, and it had all these beautiful daffodils. And so I cut down and collected some of the daffodils, and I put them into a bucket, and I went out to the street corner to sell them for $1 for a bunch of daffodils. And I was there, and people thought I was very cute, and they actually bought a lot of daffodils from me for $1 a bunch. And then my neighbor dropped by, and they said, "Oh, Mike, where'd you get the daffodils?" I said, "I just got them from the field." And they said, "That's our field." I said, "Really?" And they said, "Yes." And I said, "Oh, that means these are your daffodils. Would you like them?" And they said, "No, I could sell the ones I had in the bucket, but please don't pick any more."
And that was your start as how the economy all works.
Yeah. Reallocation of resources and entrepreneurship. That was it.
Oh, I love that story. Mike, it's so great to have you on the show. You're Associate Professor at NJIT Martin Tuckman School of Management. You've been studying bubbles for over a decade. I think that you have a very unique background as a professor. Tell us how you ended up on Wall Street for about 15 years.
I've been interested in money for a long time. And I think I've been an entrepreneur since I was, rather small. And so I was actually trading securities as an undergraduate in a small way. And so I really liked markets, and I've always liked markets. I just think they're fantastic and really, really amazing. When I was an undergraduate, I actually looked at going to one of the big Wall Street banks. So I got job offers at a couple of different places, but I decided I wanted to go to get a PhD instead. But then I went to get a PhD, and I discovered, wow, this academic thing is really long and slow and not very zippy. So I actually worked hard to get a summer job on Wall Street. So I worked for Lehman Brothers Kuhn Loeb. Now that just shows how old I am. Loved it, and worked in their front office systems area, and then was shifted over to being a trading analyst for them in their fixed income area. Yeah, took a year off from my PhD program to work for them. Worked for a bunch of famous people, and just loved it. And so when I finished my PhD, I went back and finished my PhD. When I finished it, I decided I wanted to go to Wall Street, and I wanted to do I wanted to actually make things happen. I wanted to learn something and do something, as opposed to embark on this rather slow, slightly sleepy academic career. So that's what I did, and I was actually pretty good at it.
Your undergrad, I think you went to Yale, and you got your PhD at Princeton.
Exactly. And actually, PhDs at Princeton, basically, if you got a PhD, what you did is you became an academic. You became a professor and you taught other people. At the time, it was unusual to go to Wall Street. And there weren't many PhDs on Wall Street at that time. They were interested in hiring MBAs, but PhDs they just didn't quite know what to do with. But there were a couple of groups. And the group I joined after my PhD was a famous one. It was at Salomon Brothers. It was with a man named John Meriwether. And we were known as the ARB Group. And we could really trade anything in any amount in any way to make money. And we did. My first task was figuring out how to build a business and over-the-counter options on treasury bonds. And that was my first business I built on Wall Street.
John Meriwether from Long-Term Capital?
So that was before Long-Term Capital, but yes, that is the same John Meriwether from Long-Term Capital, and many of the people who were partners of his there were my associates and colleagues at Salomon Brothers. I was in Asia at the time, and I ended up doing some different things, and eventually ending my career at Bear Stearns on Wall Street, where I was a senior managing director. I ran the global emerging market fixed income business for several years before I left Wall Street and went off to be actual entrepreneur.
You were in Asia. You've seen a lot of things. I imagine that your time on Wall Street must have been lucrative.
It was. So my first career was quite good. My second career, actually, as an entrepreneur, was ultimately quite good, although there was a pretty bumpy patch along the way. And now I'm an academic, and I don't want to put this the wrong way, but no one becomes a professor for the big bucks, But it's a great career. I love working with both students, my colleagues, the organization itself, and I do a lot of work with people in the community, actually.
When you earned your PhD, and it was not really the conventional path to take for a Princeton PhD to go to Wall Street, did money come into play?
No, it wasn't for the money. It was just I loved markets. And I wanted to do something where I kind of got feedback relatively quickly. So this academic career thing, which I love also, basically you start an academic career and your first kind of goalpost is 6 years out when they decide whether they're going to keep you or not. And that's a very long time. And there's not really a lot of feedback, and it's hard to tell kind of how you're doing up until they kind of make that decision. It's a very it's a nice career, but it's definitely not one that is, I thought of myself as kind of a young whippersnapper. And so, it's definitely not a whippersnapper type career. And so Wall Street, I had a book and I had a P&L, and I knew how I got scored every night, right? My boss, everybody got to see kind of how I did each day. And actually during the day, I knew what my P&L was pretty much on a minute to minute basis. I had very complicated positions. And so you really can see kind of like, am I doing well? I made a lot of money if I'm not doing well. And so I love that kind of immediate feedback and ability to understand the markets, use the things I learned as an academic. And so, kind of learn, use some of the deep finance to find opportunities in the marketplace where on average I could make money. And that's not every single minute or every single day or even every single month, but on average I could make money and really made a lot of money for them. And of course, in the best tradition of Wall Street, they shared some of it with me.
So with this deep experience and expertise in trading strategies and fixed income, why the leap into entrepreneurship?
So I was always an entrepreneur on Wall Street. Right? I guess I've always just been an entrepreneur in everything I've done. So on Wall Street, what I did was I built businesses. So I built a business from scratch, really in over-the-counter options on treasury bonds. I recruited salespeople. I built systems, all the things you need to do. I built a business in municipal bond arbitrage. Before I went off to Tokyo, I built a business in Japanese government bond options. We had a nascent business in arbitrage of future cash versus futures versus swaps. I made it much larger. I built a business in convertible bond arbitrage in Japan that also did really well. And then so I've just been building these businesses for like a long time. And I decided it's time to build one for myself. Because I basically build them for other people. Time to build one for myself. Yeah.
Did it feel much different to build a business for yourself?
So it does. First of all, there's like no backup. You basically, as an entrepreneur, it's a bit lonely, actually. On a trading desk, you're like peas in a pod with all of your colleagues and stuff. And, as an entrepreneur, it's a bit lonely. I did it with my wife, which was fun, and that really worked out well. But we kind of divided and conquered. And so we didn't really overlap that much. And, there's really no backup. It's not like there's like a legal team to go to or a regulatory team or a marketing team to put some press out or something or other, as you would have kind of at a large firm. So you kind of wear many hats to sort of make it work. But I loved it actually. And I really love building businesses. You learn things about yourself when you try new things. I love building businesses. I didn't actually necessarily love running them. Running them is kind of, you hire more salespeople, more people, more technicians, more delivery people, more manufacturing people, more whatever it is. And then you kind of kick their asses to make them work harder. That part I like less than the actual building of businesses. And so I built it. We actually did really well with our little business. My wife and I, we acquired several other businesses. We had millions of revenue, over 30 employees in just a couple of years. And then 2001 was a terrible year. We had between the dot-com meltdown, which hurt us bad, and then, of course, 9/11, which hurt us even worse. We went below 20 employees. We lost some money that year. But then I kind of rebuilt the business, and I sold it right at the beginning of 2007 to somebody who liked to operate businesses, and it was a really good operator. Wasn't as good at creating them, but was really good at operating them. And so that was good for him and good for me, and he's still doing it. And yeah, it's all good. I became an academic.
When did you make that decision to re-enter that slow, sleepy world of academia that you had taken a detour from years earlier?
Yeah, it was kind of always my plan to go back to being an academic. And I sort of thought that once I had been out in the world and I learned something and I knew something, then it would be sort of better for me to be an academic. And so after my experience on Wall Street, after my experience as an entrepreneur, we had the company for almost 10 years. It was time to go back. And so then I started looking for jobs. Now, this is actually the slightly embarrassing part. And that is that it is not traditional for academia to hire people like myself. Basically, it was hard to get a job. Places that would have been happy to hire me straight out of Princeton wouldn't give me a second look. As a practitioner who basically wanted to become an academic. And so I looked for jobs, and the best place that offered me a tenured track position, and that's a weird thing in academia, but if you want to be able to take ownership of academia, if you want to run programs and run courses and really take ownership, you need to be a tenured track professor. The best place to offer me a position with NJIT, and actually it's been great for me, and I think it's been great for them, where I've really, I'm now an academic entrepreneur. So I create centers and help launch institutes and bring in money and run programs and do all sorts of things that I think have really been beneficial for the institution, places where I can really use my experience.
It sounds like they're lucky to have you with such a diverse and impressive background, and with so many experiences. You bring a lot to the classroom. What was your plan of attack stepping in as a professor? How do you take those experiences and apply them to your work?
To be a successful professor, we talked about this career, you have actually 6 years to sort of build a body of work that you can claim that you should get tenure based on. And that was a challenge for me, because most people, again, if you're a freshly minted PhD, you've got a whole body of work that you've been working on that you quickly publish, and then you kind of build upon and you move forward with that. I was kind of starting from kind of a cold start from a research perspective, because as an entrepreneur, as a finance Wall Street guy, you don't publish anything. You may discover some fantastic things, but you don't publish it because, of course, those things are profitable. You wouldn't want to necessarily publish them so everybody else knew. So publishing was my first challenge. And so I basically used some of my experience, some of the history I knew, to quickly get out some publications in, frankly, not top journals, but just to sort of show that I could be in the game. And then started building data sets and building building the kind of research profile pipeline that I have now, where I have, quite a few publications that are, under review and been reviewed and need to be revised and manuscripts ready for production. And, but it takes a while to really get there. And so getting started with publications, that was a challenge for me, and still probably not my strongest point as an academic.
And your area of expertise includes bubbles and market problems.
Yeah. So because I love markets, my principal appointment is finance. I think of myself as looking at financial markets and institutions. which I know, of course, a good bit about from my background. But in particular, I really am interested in market failures because mostly markets work and mostly we just take them for granted. When you want to buy a pair of shoes, you know where to go to buy a pair of shoes. You go to the shoe store and they're going to have a pair of shoes that is pretty much what you're looking for, whether you're looking for sneakers or dress shoes or casual shoes or whatever. And they're going to have them in your size and probably your color or something pretty close. And you know pretty much what they're going to cost. And I mean, just, it all goes seamlessly. And inside the pair of shoes you bought, there was like people that did the rubber and the lace. There's people that did the leather. There's people that did the tanning. There's people that did the eyelets. There's people that did the laces. There's a whole business in like lace covers. I mean, just the number of people that were involved in producing that pair of shoes for you to get at that place and coordinated is amazing. And we just take it for granted. What we don't take for granted is when markets fail. And so when there's a dot-com bubble or a financial crisis, as we saw in 2008-9, you know, that's where the markets fail. And the question is why? And so that's really what I've spent a lot of time looking at. And so I look at market failures. I look at two types, the ones you think about, bubbles, financial crises. But then I also look at early stage companies, because it turns out that, again, partly from my background, but the challenge of matching up good ideas with money is really hard. Even the people that are the very best at it, venture capital firms, blow it more than half the time. And so that process is another one. And so I've spent time. So recently, a lot of my work has been in those two areas, really, looking and particularly looking at early stage companies.
On the bubbles and financial crises side, when we look back at history, the cause, it's a little bit different each time. Where are we today when we have a pandemic and the economy and the stock market?
The answer, if I really knew the answer to that question, I probably wouldn't tell you. I'd probably be out there trading. So I'm just going to tell you what I sort of think as opposed to what I actually know. But even before the pandemic, the markets were odd in the sense that fixed income rates, bond yields, interest rates were very low. And kind of artificially low for a long time. And that was partly to help us recover from the 2008-9 financial crisis, but they never really went up, which was odd. And so that encouraged people to take on lots of debt. And so if interest rates are low, of course, you're supposed to borrow money. But of course, that depends upon the business's operating. And so we saw a lot of success in the last decade with private equity. And so private equity is where they basically take a company and they take a perfectly reasonable company, but then they load it up with debt and take that money out of the company. Then they try to run it more efficiently and then they try to grow it and then sell it back to the public. A lot of private equity went into, for instance, retail. And with the pandemic, retail is shut down. And so retail has no income coming in. What they have is private equity on average has about $6 to $1 of debt. And so what it means is those private equity firms, so those retail firms that are in trouble, don't have any spare cash. They have to keep making their interest payments. And so we're seeing them start to go down like dominoes. And so, JCPenney just failed and there's more to come, actually. That's a consequence of this kind of financial market imperfection when this, what I would call is kind of probably a bubble in the debt market.
Can you tell the listeners what sort of things does one look for even signs of a bubble?
So you look for too much irrational enthusiasm. So what do I mean by that? So the thing that we've seen in the debt markets notably is we've seen a collapse of credit spreads. So normally when you buy a riskier bond, you get paid kind of a higher interest rate, and that kind of makes sense. But those spreads, how much you've been paid for those riskier bonds has gone down and down. And partly it's because people, I think, have been a little bit irrational in the sense that they had bonds that were yielding 10%, 8%, 7%. And suddenly they can replace them with comparable treasury bonds that are yielding 3%. And they say, well, geez, I think I'll just go buy that Nigerian bond for 5% instead. Well, yes, it's more than the 3%, but it's not enough more to really compensate you for the extra risk of owning a Nigerian bond, and not to pick on Nigeria particularly. But again, people are reaching for yield, and so they're collapsing those spreads. And of course, and then when you see real risk in the marketplace as we're seeing now, that leads to a potential collapse in that market, which is being forestalled by the Fed now. But it's not clear they can do it forever, and it's not clear, what the long-term outcome is going to be. But yes, it seems like bonds, particularly corporate bonds, particularly kind of higher yielding corporate bonds, traded at too low of an interest rate. And of course, that's part of what the private equity firms did. They basically took advantage of that by taking on this debt, or having their companies take on this debt, not themselves, at low interest rates. But even low interest rates have to get paid back. And if the JCPenney is just shut down, then they can't. And so yes, I would be wary of bonds that have credit risk embedded in them, particularly, and bonds in general, just because the Fed has been very active in the marketplace and is presumably eventually going to get, is going to stop bringing interest rates down.
Can you explain in layman's terms what the Federal Reserve Bank has been doing?
Generally, in layman's terms, the Federal Reserve Bank has been buying bonds. And so they've been buying treasury bonds, which is their normal instrument, mortgage bonds. And they haven't done too much of it, but they've certainly been promising, which, of course, a promise to do in the future is what affects the markets today. But they've been promising to actually buy corporate bonds and money market funds and things like that. And so that has had the effect of making, so if such a big buyer like the Fed is going to buy, then that makes the price go up, makes the yield to maturity go down. And so what we're seeing is very low interest rates that are supported by the Federal Reserve, who's trying to maintain the economy in the face of this, pandemic and shutdown.
Now, globally, we've seen the Bank of Japan, the European Central Bank, and the Fed. They've been doing these asset purchase programs since 2008 because of the financial crisis. How are things changing today? I mean, you mentioned the corporates and the munis. This is something we've never seen the Fed do before in history, correct?
The good news and the bad news is the Fed has been very aggressive, really unbelievably aggressive, in the face of this totally unexpected, market pandemic, a pandemic that's affecting the markets. And they're doing things which have never been done before in terms of buying corporate securities. There's even some questions about sort of how much they can really buy corporate securities under their, charters and whatnot. But at this point, they're out there being very aggressive. Mind you, the prior Fed with Ben Bernanke was also unbelievably aggressive in terms of bailing out AIG and guaranteeing the money market funds. I mean, in these crises, the Federal Reserve is kind of it's the bank of last resort. It's the bank of the banks. And so we depend upon them to do these things when we need them to. It's why they have that independence, that famous independence, et cetera. So the Fed is doing what they can, but again, they can't just kind of spend money. So that's really the job of the legislature, the Congress, and they've actually, of course, created a huge bailout package, and there's going to be what I think they're now calling phase 4. They're starting to arm wrestle on what's going to be in phase 4. But it's going to come, I'm sure.
Coming up, we talk about consequences of bubbles, why the stock market has been so resilient in the face of bad economic data, how to manage risk, all that and more right after this short break. The show notes for this episode can be found at inspiredmoney.fm/143. If you're listening in your car or wherever you are, check the show notes if you want to learn more about Mike and other things mentioned in this episode. It's time for the Runnymede Money Tip of the Week. I recently read a couple of articles talking about the rise in popularity of day trading. One of them comes from Barron's. The title was "Day Trading Has Replaced Sports Betting as America's Pastime. It Can't Support the Stock Market Forever." The gist of the article is while people are staying at home, along with binge watching TV and bread baking, day trading among individual investors has also increased. I think this makes sense because it's fueled by commission-free trading, stimulus checks, and the fact that there are no sports going on. The trillions of dollars that the Federal Reserve Bank has pumped into the financial system has created a tremendous level of fear of missing out, or FOMO. There are many places where the stock market feels speculative. It's reminiscent of the internet bubble because stocks are rising on stories and concepts rather than on earnings. I cannot condone day trading, But if you're out there buying and selling stocks or options, doing anything outside of your usual retirement plan contributions or regular investing, I hope that you'll use a stop loss order. A stop loss order is an order placed with a broker to buy or sell once a stock reaches a certain price. This is an automated way to limit a potential loss on a security position. For example, if you set a stop loss order for 10% below the price at which you bought the stock, this limits your loss to about 10%. So let's say that you bought a stock at $25 per share. Right after buying the stock, you enter a stop loss order for $22.50. If the stock falls below $22.50, your shares will be sold at market price. In today's volatile environment, this gives you downside protection if you're not able to monitor the market all day during market trading hours. You could also use a stop limit order, which is similar to a stop loss order. The difference is the stop limit order has two prices specified. First is the stop price. So if the stock hits that price, it's going to be converted to a sell order. You're also setting a limit price. So instead of converting to a market order, it's converting to a limit order that will only execute at the limit price or better. Read up on stop loss orders and stop limit orders online for more information. If you're trading, I hope that you'll take advantage of the volatility and not become a victim of it. That's the Runnymede Money Tip of the Week. Inspired Money is brought to you by Runnymede Capital Management. We help you to plan, invest, and worry less. So what's your biggest financial concern right now? If you have a question, please send me a note. Go to inspiredmoney.fm/Andy. That's inspiredmoney.fm/ANDY to email me directly. I'd love to hear from you. You're listening to Inspired Money. I'm Andy Wong. Yeah, I think that the good news is that the government, the Fed, is being so proactive because when you look back at the Depression, it was because there was a lack of doing something.
Well, that's right. And so it's the role of the government and the role of the Fed to be the bank of the banks. It's the role of the government to step in when, and to have a deficit when everybody else is kind of, not. Unfortunately, we sort of used a lot of our capacity by having some tax cuts when we weren't having a pandemic, and so that's cut the ability of the Fed and the Treasury to be government to be as aggressive as they might at this point. So far, they've been very aggressive, but you're starting to see risks, right? The risks are that of course the fractured government, the Republican Democrats, are arguing now a lot about Phase 4. It could make Phase 4 very delayed or much smaller. That would be a bad outcome. That would look a little like government stopped acting, and of course that would look a little bit like what happened during the Depression. The Depression. It's not that Hoover did nothing. He just did something and then stopped, and then wasn't willing to do any more. There's some risk that we may face the same thing. I mean, that is certainly a sobering thought.
Can the government print to infinity? I mean, when we see the current action happening, it makes one wonder, why not print whenever there's a potential recession coming? Can the government do that?
Yeah. So what makes it work is that there's slack in the economy. When there's slack in the economy, when you print money, the Econ 101 thought experiment is this, that if the magic money fairy waved their wand and everybody discovered that their salary was doubled, their savings were doubled, the money that was in their wallet was doubled, whatever they had $20 yesterday in their wallet, now they have $40, everything is doubled, and you went out and start buying things, what would approximately happen is prices would approximately double because the amount of stuff instantaneously, even if you double the money instantaneously, the amount of stuff doesn't. And so you have 100% inflation rate, right? That would be the sort of Econ 101 thought experiment. The problem is when there's slack in the economy, when there's a lot of stuff hanging around that people don't know what to do with, you can double the money and people will just buy more of it, and there's more of it to buy, and so it doesn't actually cause inflation. So that's what we experienced in sort of 2008, 2009, and that's what we're experiencing now. Eventually, it does catch up with you, and there is some inflation. But again, weirdly, inflation, like bubbles, isn't an unmitigated bad. Unexpected inflation, really distortionary bubbles can be bad, but they're also kind of how we manage the economy. And so, if there's a little bit of inflation every year, then you can kind of get a cost of living increase each year or not. But if your productivity goes down, maybe you don't, and effectively your real wage goes down. So anyhow, so a little bit of inflation, a little bit of, and some financial bubbles, even most have some positive aspects as well for the economy, and that's kind of a longer, more complicated conversation. But but at this point, with slack in the economy, we're not worried about inflation. I guess that's the short answer.
Mike, they say that the market is not the economy, but they are linked. Since you've laid out that the Fed is artificially inflating the debt market, what are some of the other consequences when it comes to the economy and the financial markets?
Financial markets are about supply and demand. And so that's really about there's actually less stock out there than used to be. And so here you are a saver, you're a person my age, you have money that you've saved. You have to put it someplace. Are you going to put it in a money market fund? Well, that's paying me approximately 0% interest right now. So that's not so attractive. Are you going to put it into the bond market? Well, I just told you the bond market's a bubble. So the answer is that seems like a bad place to put it, because when it pops, it's going to go down in value. And so what you end up doing is say, well, maybe I'll put it into the stock market. And so people have to put it someplace. And there's kind of been a shortage of stocks because with the tax cuts from prior to the pandemic, what companies did was they bought back their stocks. They created less stocks. Now there's less stock for people to buy, which kind of sort of makes the stock market go up. And so we've seen the stock market rise based on the tax cuts we've seen and the buybacks we've seen from corporations. But of course, those same buybacks use up the money that JCPenney might have had, that they could have then used to kind of keep the company going, to reinvest in online. I mean, what JCPenney should have done when they saw the close all the stores, they should have taken their money and reinvested it in online sales to sort of gin up their online sales, because people are buying stuff online, and they could have basically maybe kept themselves alive that way. But they didn't have the money because they had already bought back stock and issued debt. Now they're bankrupt. So they didn't leave themselves a cushion. In a risky world, you need to leave yourself a cushion, right? I mean, kind of a rainy day fund for a person, if you think about it. That's prudent. But a lot of these companies didn't, and were basically directed not to, again, by their principal owners, the private equity firms.
So it sounds like maybe you're not surprised that the market has been very resilient.
Well, I am a little surprised because I mean, honestly, I'm looking at the economy. Again, if there's a quick recovery, this V recovery, then it makes sense. But I'm looking less at a V and more to U, or actually lately I heard somebody else refer to it as a swoosh, right? Where it's down sharply and then kind of up rather slowly. And that kind of slow recovery is makes it hard to long run rationalize current stock prices. But there's another way to think about this that's kind of interesting. And the other way to think about it is, what are we buying with all of this bailout money, all of this stimulus from the federal government? And what we're buying is kind of public health services. We're buying kind of healthcare or health protection for the entire country. If we had done absolutely nothing, right, absolutely nothing about the pandemic, and just let it run through the country and let it overwhelm the hospitals. Again, these are not my numbers, but I've heard people talk about 2.5 million deaths, right? So there would have been 250 million people caught it, and 1% of those would have died, and so call it 2.5 million deaths, just for argument's sake. And let's say, just to make my life sort of simple here, because we've managed the pandemic in a much more rigorous way, if we continue to manage in a really rigorous way, maybe there's going to be, just for argument's sake, 10% of that, 250,000 deaths ultimately in the United States from the pandemic. That means we basically saved 2.25 million lives. And I know we're not supposed to say there's a value for human life, but again, ultimately we think about that as having a value. I think the federal government currently puts about $6 million per value of per human life saved through regulations or environmental controls, things like that. And so if you take that 6 million multiplied by the 2.25 million lives we saved, that's over $13 trillion that we're protecting. If you spend a couple $1 trillion, $2, $4, $5 trillion to save $13 trillion worth of human life, that's probably a good trade, right? And if you looked at it that way, the economy is actually not doing nearly as bad as you think. All the shutdowns, which are being bailed out by the government, are about reallocating resources to pay for public health services. Again, that's a back of the envelope calculation. Don't really hold me to that one. But the point is that if you think about it sort of a different way, you can see why it makes sense for the government to be spending trillions of dollars and why they should even continue spending trillions of dollars.
Interesting. I hear your background as a arbitrage guy, making a quick back of the napkin calculation to see, is it a good trade or is it a bad trade? The economic data that you look at, can you give us a little bit of context? How bad does it look?
It's hard to tell. On the negative side, we've seen retail sales fall at unprecedented numbers. I mean, 8% last month and over 16% this month, right? I mean, the record was like 4% during the Great Recession. So these are really big numbers. And of course, unemployment claims have gone through the roof. I mean, during the Great Recession, the worst month ever was about 800,000 claims. We have now, over the last 2 months, had 36 million new unemployment claims. Again, back of the envelope calculation, where that suggests we're talking about 20% of the workforce, maybe a little bit more even, losing their jobs. And if you add that to the 3.5% we had before, that would suggest that we should have an unemployment rate when they eventually calculated of in the low 20s. Those are unbelievable numbers. Those are Great Depression numbers. So if we don't do something about that, then it looks like there's potential for Great Depression, and that's scary. But on the other hand, if 80% of those people who have been claimed unemployment think it's temporary, think that their place of business closed, their retail store, their restaurant closed, their travel business closed, their hotel was closed, but when it opens again, they're going to get back their job again. And so this is temporary. So to the extent that we can make it temporary and really get people back to work relatively quickly, then it's not so scary. But so that's really the question, and that's the big unknown. And how long is that going to take? And that's the V versus swoosh question. And again, if I knew that one, well, I probably wouldn't be telling you.
But it sounds like that's the critical variable at the moment.
That's the one. Yeah, how quickly we can get back. And again, it's not totally random. I mean, if the federal government were to stop doing bailouts, if there was no phase 4 bailout, it's okay, we're done. Now everybody else is just on their own. That's kind of a Hoover-esque sort of move. Then those businesses would actually close. Those hotels or restaurants would actually just go bankrupt. And then the banks have assets on their balance sheet they don't want, and they can't lend. And and that's the sort of the Great Depression scenario. So that's really why phase 4 is going to happen, because ultimately people are going to recognize that nobody wants to be the modern day Hoover, but it's complicated, and the question is how much and how fast. Those are of concern, and those are big variables, and nobody knows what the answer is going to be.
It also seems challenging because the United States is a big country, and we're seeing a lot of the reopening up policies being left to state governments to decide on timing and what their policies are going to be. How do you take that all in? Should we be looking at it as a whole, or does it get very complicated looking state by state and case by case?
So it's a tough time to be winging it. Countries like New Zealand, where they had a well-established pandemic plan, they literally had a pandemic plan that they had established based on sort of the fact that this was likely to happen at some time. And what they did is they basically said, okay, and the leader of New Zealand, Jacinda Ardern, basically enacted the plan. She didn't start from scratch. She didn't think of this anew. She said, look, we've had smart people thinking about this for years and years. Here's the plan that the smart people kind of came up with, whatever, put in place, and they've done really unbelievably well on the strength of that. Taiwan had a plan. They said, if there is another pandemic, we're going to immediately stop every single person on the airplanes, take their temperature, check their health, follow them, have mandatory quarantine for a couple weeks. They really had a plan and they put it into place, and it's worked extremely well for them. The United States actually had elements of a plan, but we dismantled the infrastructure around that plan. There was a National Security Council group that was absolutely the pandemic response team. They had gamed out some of these situations. The Obama administration and even prior to that had gamed out the pandemics and thought about sort of some of these things. But then when the time came, what we did is we sort of winged it. And winging it in these situations is not good strategy. And so we missed some opportunities early on. We did not have a coordinated approach from the federal government. So therefore, in a vacuum, leadership devolved to the states. And the states have banded together. You've seen the group of Western states, a group of central states, and a group of Eastern states band together. Because basically nature abhors a vacuum, and if there's a leadership vacuum, it's going to get filled. And so we've seen the governors stepping up, and in a way that we needed them to. That could have been largely done from the federal government. The kind of I'm in New York, and so if you look at the 7 standards that the governor set for basically opening up the 10 regions of New York State, that same kind of thing could have been done across the country, and probably and other states are doing kind of their own version of it. But rather than having everybody reinvent it on the fly, it's good to have a plan, and it's good to have experts who know the plan and then be able to execute as they did in New Zealand or Taiwan, and we missed that.
Given that you were a trader, you understand risk and trying to mitigate risk. What's your assessment currently? If you were trading today, do you want to play? Do you not want to play? How do you manage risk at this moment?
So the world is risky. Whenever the world is risky, it makes sense to sort of reduce the risk in your portfolio. Everybody can sort of absorbs a certain amount of risk and is comfortable with a certain amount of risk. And so if you think the world's not risky, you can kind of be a little more outraged, take a little more risk in your portfolio. But if you think the world and your job and all the other things are really risky, then you want to take less risk in your portfolio. And we're seeing kind of that general, what they call flight to quality. We've seen people going from corporate bonds to treasury bonds to money market funds, foreign stocks to U.S. stocks. All of that is part of kind of the flight to quality. And so I would say that, that's okay. Personal finance advice. In a perfect world, you actually have a financial advisor that you pay on a fee basis, who's not a broker who's trying to sell you stuff, but is a financial advisor you pay on a fee basis. And you've basically worked out the plan. They've helped you assess your risk. They've helped you consider what the possible risk in the future might be. And you've established a portfolio that you can live with in all of the expected states of the world where there's either risk, a lot of risk, or not so much risk. And now, when there's a lot of risk, you've already kind of thought about that. You and your advisor have already thought about that. And this is a good time to do absolutely nothing. Okay. So that's really where you should be. Having said that, if you don't have that advisor, if you find yourself with too much risk, people need to sort of figure out how to bring their risk down. I would say that, I've had good advice, and I have a sense, I advise myself as well as I talk to others as well. And so I've had a lot of what they call in the trading world dry powder, and I would say, and maintaining that. I don't think we've seen the world become less risky. I think it's potentially going to become more risky over the next several months as we recover or don't. So I am sitting on my hands waiting to sort of see how things shake out. It's not a time to jump into the stock market or bond market. And the extent you have money in a money market fund, it's in treasuries and high quality instruments, and it's earning zero, but it's at least not going down, and it's kind of just holding itself. And there's not a lot of inflation right now, so it is what it is. And so that's kind of my position. I have made some investments in some sort of special situations where I've seen there's been short-term opportunities but mostly I've been investing in very early stage companies, non-public companies, where there's kind of opportunities just in the last month or so.
Since you point to the debt market as really the source of the bubble, is that where investors should be focusing on signs of this bubble possibly starting to burst? Or is it hard to know where to look?
It's always hard to know where to look. So there's two. So it turns out knowing when you're in a bubble is not crazy difficult because you can see the distortions in the marketplace. Knowing where it's going to crack is quite hard. Is it going to be high yield sovereign bonds? Is it going to be private equity debt? Is it going to be, where is it going to crack? It's hard to tell. We could see a crack in commercial real estate, right? So debt to commercial real estate, that's a vulnerable area because, I just been reading, but the big banks have all sent all their people home. And JP Morgan Chase, now second largest landlord in New York City after WeWork, but JP Morgan Chase basically sent all their people home. And you know what they discovered? Geez, we can just keep running the bank. And even though offices are empty, the place runs pretty good. And maybe they don't need all that space. And if JP Morgan Chase and all the other people figure they don't need all that space, then there's a whole lot of extra commercial real estate here in New York City that could go down in value. And if it went down in value and was empty, then they can't pay their mortgages, And so that would be then the form of debt that you would be worried about. So where it's going to break is really hard. And then the really, really, really hard one is when it's going to break, right? Because right now, commercial real estate, those guys have been very wealthy. They've made a lot of money over the last few years. The extent that they've held some cash aside, even if they're empty, they can sort of live empty for a while and they can sort of not admit that their real estate has gone down in value. It could take a long time. It could take years before we see kind of a crack in that market. Yeah. So exactly where it's going to break and exactly when it's hard and when is super hard. But I would say in general, those are places not to put money. I would not be lending money to commercial real estate developers right at this moment in time. Certainly not at the kind of interest rates that are in the marketplace. And I wouldn't be lending money to, Venezuela or Nigeria right at this moment in time either. Not yet. So dry powder. That is where I am right now, waiting, sitting on my hands, waiting to see how things shake out.
Yeah, we see that a lot in the smart money. You see Warren Buffett sitting on a lot of cash and a lot of well-respected investors not rushing in to put their money to work.
There's a trading saying that no one wants to catch a falling knife. So you wait till it falls and then you pick it up. And so I think we still have a falling knife.
Mike, I'd like to ask all the Inspired Money guests, how do you define success?
Complicated question. Simple answer is, am I proud of myself and what I'm doing? Do I feel that I am doing something valuable and important that makes sense? The answer is that is the beauty of an academic career. I have a tremendous amount of latitude to do things that I think are important and make sense and are valuable. I love helping young students. I love helping my colleagues. I'm working with a lot of students and colleagues on starting businesses, helping them take their ideas and bring them to the marketplace. I work with some early stage companies as well. All of those things are things that make me feel good about my contribution to the world and the next generation. And by the way, just to shout out, I love the students that I have. We have wonderful students at NJIT. They are smart, hardworking, upwardly mobile, ambitious. They're the future, and the future is bright because they are excellent people trying to do good things. And so this pandemic, this too shall pass. And so the question is, after it all passes, do I feel good about my contributions? And do I feel good about sort of what I've done to sort of help in my small way, arguably very small way? That's what I think success is. And closer to home, I look at, my own family, my own children, my spouse, is everybody doing well? And if that's true, then I am succeeding. I'm doing what I want to and need to and should be doing.
Well, thank you, Mike. Thank you for sharing your thoughts and your expertise with us today. Can you tell the Inspired Money listener where to find more about you, to find your work, and where to follow you?
So LinkedIn, I'm active on LinkedIn. Basically, I have a website at NJIT. I do not have much of a social media presence. That's just embarrassing. I'm old and, whatever. So I would say, those are probably places to find me. What I would say is come by NJIT. I am available. Call me up, send me an email. I have lunch with people. I meet lots of people. So I'm not really, I'm not trying to make myself unavailable. It's just that I'm just not much of a social media player.
Thanks, Mike. Thank you so much.
Andrew, it's really been a pleasure.
So what was your favorite Inspired Money moment? I really like hearing Mike's thoughts on bubbles and the financial markets right now. I particularly appreciate his personal finance advice. Work with an advisor to review your circumstances and devise a plan. I'm sure you're not surprised by this, as I am a fee-only financial advisor myself, but I do agree that an advisor can help in this regard. I also like the advice to keep dry powder in riskier or uncertain times. I think that that's a really good tip. As I said earlier, there is a fear of missing out, FOMO, in the stock market, in the face of a lack of visibility and lots of uncertainty. There's risk of more businesses, both big and small, to go bankrupt. This is a risk to banks that hold commercial loans. We also don't know how quickly or smoothly the economy is going to recover as cities begin to reopen. If you had a different favorite Inspired Money moment or thoughts on today's topic, please message me on Instagram at inspiredmoney.fm. That's instagram.com/inspiredmoney.fm. If you like this episode, please do me a favor and share it with someone. Post it on social media, tag a friend. For that, I'd be extremely grateful. Inspired Money is edited by Christopher Wright of Wright Media. Thank you so much for joining me. If you're not yet subscribed, I hope that you'll do it now to ensure that you won't miss next week's show. I'll see you then. The music you're listening to right now and all other music on today's show is by the amazing Jim Kimo West. Have an inspired week and do something that scares you, because that's where the magic happens.